Every day, new traders struggle with trend lines. What makes a trend line valid and how to draw them properly. So in this video, I'll walk you through the 6 essential steps to plot trend lines correctly, common mistakes to avoid, and clear up all the confusion on trend lines. By the end of the video, you will be plotting trend lines like a pro. I'm Z, and after 4 years of trading Forex, I've learned that many trading concepts are explained in overly complicated ways. That's why I'm here to break things down simply and clearly, just like I wish someone had done for me when I first started. This is educational content, not financial advice, so without any further ado, let's dive right in. Trend lines are straight lines that are drawn on the chart that connect 2 or more price points. Trend lines help traders identify the overall direction of the market, whether it's moving up or moving down, or the market is ranging. Just think of a trend line like a guide rail that is placed under the price swings or above the price swings. It doesn't have magical predictive power, it just simply visualizes what buyers and sellers are doing. Trendline is just as effective as other methods of technical analysis when it is used correctly, but many traders misuse trend lines by trying to force them to fit the market, rather than letting the market dictate the line's direction. A properly drawn trend line should reflect the natural movement of the price that guides traders in understanding the market trend. As a beginner trader, trend lines are important because they reflect market behavior, psychology, and sentiment. In an uptrend, buyers step in at higher lows and buy, then take their profits when the price goes up. In a downtrend, sellers step in at lower highs and sell, then take their profits when the price goes down. But when the market is ranging, the buyers and sellers are balanced and have equal strength. Trend lines reflect market sentiment of buyers and sellers. When traders are using trend lines, they are visually interpreting the balance of power in the market. Uptrends show a bullish sentiment because buyers are stepping in at higher price levels, while downtrends reveal bearish sentiment because the sellers are more active and pushing prices lower. When you understand the sentiment going on in the market, it gives you an edge that makes you know which sentiment is dominant. Another importance of trend lines is that they help traders define their entry and exit points. For example, in an uptrend, a trend line serves as support. If price pulls back to the trend line, it could be an opportunity to enter for a buy. In a downtrend, the trend line acts as resistance. If price pushes back to the trend line, it could be an opportunity to enter for a sell. Another most powerful feature of a trend line is that when a trend line breaks, it can mean a change in the market trend. In a bullish market, when the price breaks below the trend line, it might suggest that the buying pressure is getting weak and a trend reversal or consolidation might start. In a bearish market, when the price breaks above the trend line, it might mean that the selling pressure is getting weak and the price could start going up or might start ranging. So how can you properly draw a trend line? To draw a trend line is pretty much easy. When drawing a trend line for an uptrend, the trend line is drawn below the price, which is called an ascending trend line. When the trend is a downtrend, the trend line is drawn above the price, which is called a descending trend line. When the market is not trending either up or down, but is kind of consolidating, you draw what is called a horizontal line known as support and resistance. It is called a trend line, meaning the market has to be trending for you to use a trend line. But if the market is not trending, you draw a horizontal line for support and resistance. Please note that trend lines are also considered dynamic support and resistance. So back to how to draw a trend line. Drawing a trend line is kind of straightforward, but doing it correctly requires understanding the price action and identifying significant levels of support or resistance. So here is a step-by-step guide on how to properly draw a trend line. Step 1. Choose the right time frame. Start with a higher time frame. Trend lines on higher time frames, like the daily, 4-hour, or weekly charts, tend to be more reliable. A trend line on a 1-minute chart doesn't hold much water because small price movements don't show the overall market sentiment. If your goal is for long-term trends, then you should focus on the daily or weekly charts. But for short-term traders like day traders and scalpers, you might use the 1-hour or 15-minute charts. Step 2. Identify the trend type. You need to understand what kind of trend you're dealing with before drawing the line. When the price is consistently moving higher, you'll draw the trend line along the swing lows, that is, the lowest points where the price dips before going up again. In a downtrend, when the price is consistently moving lower, you'll draw the trend line along the swing highs, that is, the highest points where the price rises before going down again. In a range market, instead of drawing a trend line, you will look at horizontal support and resistance levels where price touches and bounces off and draw your support and resistance. Step 3. Identify the swing points. To draw a trend line, you must identify significant swing points. These points are where the price changes direction, either a swing low or a swing high. When I say significant swing high or low, it simply means you should focus on the main swings, not the minor ones. The minor swings will distract you and will make your trend line inaccurate. I'm not saying you should disregard them, but when drawing a trend line, the major swings are all we need. Step 4. Connecting the points. Once you've identified the swing highs for a downtrend or swing lows for an uptrend, you will then connect these points with a straight line. If your line cannot connect all the major swing lows, that is fine. As long as you have 2 to 3 touches, that is okay. The first touch means that you identified a trend. The second touch means that you've confirmed the trend. If there is a third touch, that's even better. It gives the trend line more validity. The more times the price reacts to the trend line, the stronger it becomes. But note that the line should touch at least 2 points. Step 5. Extend the trend line. Once you have connected the swing points, you should extend the trend line to the future that is the right side of the chart. This will help visualize where the market might head next. The line you extended to the future shows where price may return to as support if the uptrend continues and where price may return to as resistance if the downtrend continues. Step 6. Avoid forcing trend lines. It's important not to force a trend line to fit the price action. If you have to adjust your trend line multiple times to make it fit, it's probably not valid. Trend lines should naturally connect swing highs or lows without requiring manipulation. The trend line should represent the market behavior as it is, not as you wish it to be. Now that you know how to draw a trend line, let's talk about how many traders misuse trend lines and the common mistakes to avoid. When it comes to using trend lines effectively in trading, many traders fall into certain common pitfalls that lead to inaccurate analysis. Number 1 is misinterpreting trendline breaks. Beginner traders often misinterpret a trendline break. They might assume that a break of the trendline automatically means a trend reversal and jump into trades without proper confirmation. Sometimes price can break a trendline temporarily and then return to the trend, which can mislead traders into early exits or entering the wrong trades. So a break doesn't automatically mean the trend is reversing. Other price action analyses should be used to confirm that a trend reversal is indeed happening. Secondly is using trend lines in isolation. Relying exclusively on trend lines without using other forms of analysis or confirmation tools is another common error. Many new traders fail to incorporate candlestick patterns or other confluence alongside trend lines. Trend lines alone are not enough to make informed trading decisions. They represent only one part of the puzzle. Without confirmation from another form of analysis, it can cause misinterpretation. The third one is not adjusting trend lines over time. Once traders draw a trend line, they may assume it's fixed and permanent. They draw trend lines without adjusting the trend line as new price action develops. The market is constantly moving, and the trend line may need to be adjusted as new swing highs or lows are formed. If they stick to an outdated trend line, traders might miss opportunities or reversal signals as the price moves away from the previous trend line structure. As new significant price points are made, the trend line might need to be redrawn and adjusted to reflect the evolving market trend. The fourth one is overcomplicating trendline analysis. Some traders become obsessed with perfection, trying to find the perfect trend line, and end up overcomplicating the chart with multiple trend lines crisscrossing each other. Too many trend lines can confuse traders and lead to indecision. Overcomplicating the chart makes it harder to identify key price levels and trends. The more trend lines you add, the less clear the picture becomes.
Keep your charts clean and simple. Use only the trend lines that represent the most significant price movements. Don't overcomplicate your analysis by drawing unnecessary lines. Then lastly is drawing trend lines on low-quality data. Drawing trend lines on lower time frames like 1 minute or 5 minute instead of using higher time frames for serious analysis. Lower time frames are often affected by noise and market fluctuations, which makes trend lines less reliable. So traders might get distracted by small price changes that might lead them to trade based on weak signals, which increases risk. So drawing trend lines on higher time frames like 4-hour or the daily time frame produces more accurate analysis. Then use the lower time frames for entry once you've identified the overall trend on the higher time frame. Okay, that's it for this video. Drop me a like, drop your comments, and please subscribe to my channel, and I'll catch you on my next.